Yes, welcome to today's revision. Today we are going to do the financial accounting paper, which was done by the CPA students, KASNEB students. This paper was done on 2nd December 2024. It was done on 2nd December 2024. We will tackle each question per question so that we can be able to understand how, as a student, you were expected to answer the questions that were asked there. Now, if we start with question one, is asking, question one, number A, in the context of public finance, in the context of public sector accounting, in the context of public sector accounting, explain the following. We have been given first, we need to explain what we refer to as contingent liability. Then second, we need to explain the social benefits. And all these have got 2 marks each. Okay, so that which makes it 4 marks. Now, when you talk about contingent liability, first, let's understand this, the term contingent, the meaning of the term contingent. When you talk about the term contingent means that is, it's kind of like uncertainty, something that you are not sure whether it's going to happen or probably it won't happen. So it's kind of like a 50-50 situation. The probability of it happening equals the probability of it not happening. So in this particular aspect whereby it's a situation whereby, for example, literally you can say farmers in Kenya are going to plant based on whether it's going to rain or not. So that means that the probability of farmers planting depends on the rains. So it means that if it rains, the farmers will plant. If it doesn't rain, then it means that farmers are not going to plant, which means that if they are not going to plant, it means that we are not going to have enough food in that aspect. So let's come back to accounting. When you talk about contingent liability, these are liabilities that are likely, or the probability of them happening is kind of 50-50 situation. And their happening depends on certain, probably circumstances. They're likely to happen, they're likely not to happen. So in our definition, we have explained it as a contingent liability is a potential obligation that may arise in the future depending on the outcome of an uncertain event. So which means that if that event occurs, then probably you're likely to incur those liabilities. But if the event does not occur, then likely you are not likely to incur those liabilities. So it's not recognized as a liability in the accounts, in the accounts, unless it's probable that an outflow of resources will occur, and the amount can be reliably estimated in terms of how much are you likely to estimate. Like for example, there was a time there were rains, there were floods in Nairobi, and people's homes were destroyed. Other people died on stuff like that. And you see, then came there were so many accusing fingers to the county government, specifically. Let's now talk about Nairobi. There was a lot of accusing fingers that the county government of Nairobi was not prepared to deal with the floods and all that. Then it came a situation in the next year season, of course, from the meteorological department, the weatherman gave a warning that we are likely to experience some heavy rains this year and all that. We saw the county governments preparing. We saw Nairobi County buying boats, incurring costs of trying to move people who are in low areas, low areas and stuff like that, and all that. So you see, such kind of an activity was based that there was a probability that if it rains, and most of the county, even before purchasing, most of the counties set aside, I think some, we call it emergent fund, that in case it rains and we have floods, there will be money that has been put in the budget which can be used in sorting the mess or saving lives and such kind of issues. So that is the best example on that. So it is recorded in the financial statements only if the occurrence of the event is probable and the amount can be reasonably estimated in terms of how much are you likely to spend in such kind of an event if that event occurs. So otherwise, it is disclosed in the notes on the financial statements if you are not sure, or the probability is a bit low. So like for example, we have given an example there. A company is involved in a lawsuit where a customer is suing for damages worth 1 million. The company's legal team assesses that there is a 40% chance the court will rule against them. So in the accounting statements, what is going to happen, since the outcome is not probable, which means that there's it's less than 40% likelihood, the company does not record the 1 million as a liability in its financial statements. So what it's going to do, because the lawsuit is material, the company discloses the contingent liability in the notes to the financial statements, explaining the nature of the lawsuit and the potential financial impact. So when it comes to recording a contingent liability in the financial statements, first is that when the contingent liability is probable, it's estimated, that is to say it's more than 50%. So like for example, you're given a company is facing a lawsuit with a 70% chance of losing the case, the estimated settlement probably is 500,000. So what is going to happen in the journal entry? We are going to debit the lawsuit expense at 500,000, and in the profit and loss account, we are going to put that lawsuit as an expense. And at the same time, we are going to credit, in the journal entry, we are going to credit the lawsuit liability at 500,000, and in the balance sheet or the financial statement, we are going to put that as a liability, as a liability in the financial statement. So what that means is that the liability is recognized in the balance sheet, and additional details like nature suites, all those will be disclosed in the notes of statement of financial statements. Secondly, when the contingent liability is possible but not probable, which means that it's not reliable or measurable, like for example, the company is sued for 1 million, but the legal team advises and says that there's an only 40% chance of losing, then that means that in the journal entry we don't enter that information. We only enter that information in the notes in the financial statements, but in the journal entry we don't enter, so which means that we don't even enter it in the profit and loss account, we don't enter it in the balance sheet or the financial statement. Also, when the contingent liability is remote, which means that it's less than percent, for example, a frivolous lawsuit with a 5% less chance of success, there is no entry that will be made on that aspect. So that is how we deal with the contingent liabilities in public sector. It means that those liabilities which is happening depends on certain events. If they are probable, they are more than 50% that you are sure they're going to happen, then of course we can enter them in the journal entry, we can enter them in the financial statements. But If the probable is less than, they're not probable, which means that they're less than 50%, it means that we don't record them, but we put them in the notes on the financial statements. And that is how we deal with the contingent liabilities. Secondly, we have been asked to talk about, to explain on the social let's talk about the social benefits. Now, when you talk about social benefits, these are transfers that are made by government to the public for the purpose of probably like trying to improve the living standards of people. Like, for example, a payment of pensions. Let's take, for example, during Corona period, there were a lot of people who were rendered jobless. There were lockdowns, people could not go to hustle and all that. So in some parts, government departments and the government at large had to send some cash to people for them to be able to use to buy, let's say, like foodstuffs for the purpose of maintaining, for not letting them die hungry. If you remember the previous, in the campaign period in our last election, the people who were in Azimio coalition were promising 6,000 shillings as a social benefit, maybe to vulnerable families. So where you are given 6,000. So when you talk about social benefits, basically these are transferred made by government to individuals or households to provide economic assistance. So they refer to non-exchange transaction, which means that the money is going out, but there is no good or service that coming or is coming in or that is being done. So they refer to the non-exchange transactions by the government or public sector entities to individuals or households to improve their welfare. So this includes, for example, pensions, unemployment benefits, healthcare subsidies, or other welfare program funded by the public or using public resources. Now, when it comes to recording of these social benefits, first, we record the social benefits as expenses in the government is accounts. In other words, social benefits are recorded as expenditure in the government's financial statements because they represent resources transferred out to individuals or to households without a direct return. So you are not going to have this direct return. Like, for example, when the government pays out social benefits like pensions and employment and all that, so we record them as expenses. It records an expense under relevant social welfare or benefits expense account. So this reduces the government's net assets or increases its deficit for that for the period that is recorded. Secondly, under recognition principles, in terms of accrual basis, social benefits are recognized as expenses when the obligation arises, even if payment occurs later. So in terms of accrual basis, they are going to be recorded when that expenses are recognized. So it doesn't matter when the money was disbursed. So for example, pension obligations are recorded as soon as the eligibility criteria are met. When it comes to non-exchange transactions, since social benefits are transfers with no goods or services received in exchange, they are recorded as expenses and not as assets because there's nothing coming back. Like, for example, in a journal entry, when paying a pension, you are going to debit the social benefit expense, that is the pension expense, and you are going to credit cash or bank. Lastly, in financial reports, social benefits appear under government expenditure in the statement of financial performance or comprehensive income. And in some cases, long-term social benefits obligations like pensions payable in the future may be recognized as liabilities on the balance sheet in that aspect. So, in a nutshell, that is how you explain the two terms, contingent liabilities and social benefits. That is how you explain them, and that is how we treat them when it comes to recording those statements in the financial statements. Now let's talk about question 2. Question 2 asks, outline 4 reasons for incomplete accounting records in sole proprietorship business organizations. You're being told that outline 4 reasons for incomplete accounting records in sole proprietorship business organizations. Now, when we are talking about accounting records, basically we are making reference to the documents that are used for accounting. Like we can talk about preparing of the profit and the loss income. We can talk about preparing about the journal entries. We can talk about the financial statements, invoices, and all those other record or documents that are used in purpose of accounting aspect. Now, when we talk about the accounting records or reasons for incomplete accounting records when it comes to sole proprietorship, a sole proprietorship is a business or a venture that is being owned and run by a single individual. So when you talk about sole proprietorship, these are businesses, especially the small enterprises, the small businesses like the boutiques, the small boutiques, the retail shops, somebody running a butcher, somebody running a grocery and stuff like that. So those small businesses mainly are the ones that fall under sole proprietorship. So these are businesses that are owned and run by individuals. Why we are likely to have incomplete accounting records in such a kind of business ventures? Firstly, is because there's lack of accounting knowledge. Most of the business entrepreneurs, most of these sole proprietors do not have the accounting knowledge in terms of how to prepare those documents and stuff like that. So you'll find that because when you're starting a business, there's no qualification that requires you or that determines that you have to have for you to start your own business. In terms of sole proprietorship, it's one of the most common type of owning a business because it doesn't have any major formalities. You have the money, you have the idea, you can you get the required license and all of that, you start your operations. So you'll find that majority of the sole proprietors do not have accounting knowledge in terms of how you can prepare the documents, how you can prepare and get to know the tax that you are supposed to pay, how you are supposed to prepare to determine whether you're making profits, how much profits you made and stuff like that. That is why most of the sole proprietors or the small businesses, they even don't know whether they're making profits or they're making losses because they don't even have, that they're selling. It's not like in a supermarket where you are selling, even if you're buying a product that is costing 1 shilling or even 5 shillings, it's being scanned, so it's being recorded. But in most this sole proprietorship type of business, even when you are selling products, sometimes you do not have records. Not all of them issues receipts to be able to track how much sales they're making. So that aspect of lack of accounting knowledge or lack of experts makes it reason enough for not having proper accounting records. So we say that many sole proprietors start businesses because of their skills or passion in a particular trade, not accounting. So without formal training or experience, they may not understand how to maintain accurate financial records, apply accounting principles, or even use accounting software. So this knowledge gap can lead to errors, omissions, or even incomplete record keeping. They might miss recording some transactions or even fail to categorize expenses and revenues correctly. So lack of accounting knowledge and lack of experts is the main reason why you're likely to have incomplete accounting records in sole proprietorship. Number two, there's the aspect of time constraints. So in other words, sole proprietorship or sole proprietors mainly, we have said these are businesses or these are individuals who are running the businesses by themselves. So you'll find that they have a lot of things to do. They have a lot of, like for example, somebody wakes up, he needs to make orders, he needs to ensure that he follows on the delivery of those orders, he needs to ensure that he's serving clients, he needs to ensure that work is done and all that. So they do not have time. Like for example, for the formal or in corporate organizations, you will find that people are employed to do specific roles. If you go to a bank, the bank starts operations at 8:30, for example. But the officials need to be there, let's say, by 7, so that they can prepare for opening and all that. They will do the operations probably from 8, maybe all the way to 5 p.m. Now, after 5 p.m., they close their doors. The only customers who are within the bank, they're the ones who will transact and then leave. Maybe probably by 5:30, they could have finished with those customers. Now then, these guys do not just close the bank and leave. They need to start doing reconciliation. Somebody who closed, the bank was closed 5:30, the bank officials might leave that bank at even 7:30. Because they will have to do the reconciliation, and especially in a case whereby they had so many clients during that day. So they have a lot of reconciliation to ensure that the records are balancing and all that before they can close the day's business. So in terms of sole proprietorship, that time by the owners, they might lack that time because mostly they're the ones doing almost all things within the business. So you'll find that running a sole proprietorship often involves juggling multiple roles, managing sales, purchasing, customer service, and administrative tasks. So the owner might prioritize these operations duties over bookkeeping. So since accounting can be time consuming, especially without automation, record keeping might be neglected or even delayed, resulting to incomplete or even outdated records. Thirdly, the third reason is for the purpose of, or in reason to informal business practices, or what you call simplicity of business. So, men sole proprietorships or men sole proprietors are small-scale operations with relatively few transactions, so often conducted in cash. So because of this simplicity, owners may not see the value in keeping detailed records. So informal business practices such as not issuing invoices, informal cash handling, or mixing personal and business finances, this can also lead to gaps in accounting records. So the perception that the business is too small to require formal accounting further discourages proper record keeping. So when you talk about the informality of business practices or the simplicity of the business, here we are talking about suppliers supplying products, and the sole proprietor says that because I have seen the products, I know the price of this product, you don't need even to give me a receipt. For me to pay you, probably I don't even need to, you don't need to give me an invoice. Just tell me the amount, I can send it through M-Pesa, or just send me the amount, I can, deliver that amount and stuff like that. So you'll find that in such kind of situations, there might lack records or proper documentation that will be used in such kind of informal business practice. Another reason is due to cost of professional services, cost of consideration. So sometimes hiring professionals like accountants with relevant experience might be costly, and the sole proprietors might not be willing to incur this cost. They might see that the cost is too much for them, or the cost is too much, and they might not see the importance of this record, the records and all that. So they don't see the reason for them to incur this cost. So they ignore it. So at the end of the day, you're likely to have errors in those documents. So hiring professionals, accountants, or bookkeepers can be expensive, especially for a small or new business with limited funds. So sole proprietors often try to minimize expenses to preserve cash flow. So they may choose to handle accounting themselves or not keep detailed records at all. This cost-saving mindset, while understandable, can compromise the quality or the completeness of financial information. It reminds me of an example. I had a friend of mine. This friend of mine was running a wholesale business. So what happened is that now this friend of mine running the wholesale business, he was a sole proprietor, and is a person who was not that educated, but is a person who was, let's say, kind of a hustler, because he had grown right from studying a small, running a kibanda, all the way to grown his business all the way to becoming a wholesale. Now, there was a time that this person wanted to apply the loan. So I told him to bring the statement so that we can be able to go through the statement and check on that. So the guy was banking with one of the banks around. So what happened? This guy was very comfortable the way the operations were running, because normally he was getting in touch with the branch manager of the bank. He had his own relationship officer. He could call them anytime. He could get whatever he wanted. His checks were not likely to bounce, even if he didn't have cash and all that. So what happened now? Because he had good transactions on a daily basis, so the bank also approached him and they told him to give him an asset finance. So they financed him to buy a car. So he purchased a car of 1.1 million. Now, when he wanted to apply for a loan in a different bank, so he was asked to produce this statement. So what caught my attention is that when I was trying to look at the statement, most of the time the bank balance, as much as this guy used to do transactions, heavy transaction daily, okay, not that heavy, but he used to deposit 100, 200,000, 300 and stuff like that on a daily basis. But I was worried, why is it that all the time the bank balance was negative? So which means that, yes, he had an overdraft, but that overdraft, sometimes when it runs too much, it means that this person is he cannot, is operating on negative and stuff like that. So I was worried, how comes that the bank balance is running an overdraft for too long? So when we try to go through easy transaction, each one by one, this guy realized that there were some transactions that were being done without his consent. In fact, that money was being withdrawn from his bank without his knowledge. He was happy because, there was no check that was bouncing. He was happy because he had that kind of good relationship from the bank. He was happy because even the bank gave him a car loan. They're deducting the money from the account, even without his consultation, because he gave a standing order and stuff like that. So at the end of the day, what came out is that the bank officials knew his weakness. And once they knew his weakness, whenever what was happening is that whenever a check came in, for example, a supplier has supplied goods, the guy has written him, the supplier, a check. Maybe the check is of 300,000. Of course, there is an overdraft there, so the check will go through. I think the officials in the bank could withdraw 350,000. Rather than withdrawing, passing that check of 300,000, they could add a top 50,000. So when money is deducted from his account, when it goes to an overdraft, it doesn't go with an overdraft of 300. It goes with an extra 50,000. And now this money could be used. So I think that is what was happening. IMI was very happy because suppliers are supplying. Of course, the checks are going through and all that. But at the end of the day, if you calculate how much money he had lost without probably during a long period that these guys were managing, it's millions and millions of money. So sometimes you find that it could not get such kind of information because most sole proprietors do not want to incur the cost of professional services. They don't see the value of this. But at the end of the day, these guys are very important in determining effective or financial stability of your organization. The next, we have the mixing of personal and business finances. You will find most sole proprietorship do not have accounts for their businesses. Their personal accounts at the same time runs as their business accounts. So they do not have personal money and business money. So when they have their money, you have your own money, you have worked somewhere, you have been paid 20,000, you put in that account. The business money after selling the goods, maybe 50,000, he puts that account. If you go to check the account balance, it's 70,000. Now, if that is a tradition, it becomes difficult to determine your money and all that, because if you are going to withdraw the money to put in the business, probably you are going to withdraw all the 70,000 and buy products. What it means is that you have introduced a new capital of 20,000 from outside to the business. So the business will keep on operating, but now that business you will not tell it's not making profits, because every time you introduce new capital from outside and you put into the business without accountability. So sole proprietors often use the same bank accounts or cash funds for both personal and business expenses. So this blending makes it difficult to keep clear, separate records of business transaction, leading to incomplete or inaccurate financial data. Then we have lack of motivation or perceived importance. So when you talk about lack of motivation or perceived importance, some proprietors may not fully appreciate the importance of maintaining proper records. So especially if they view accounting as a burdensome task with no immediate benefit. So this attitude can cause them to neglect bookkeeping. So you see, like from the example I've given, where somebody is running the operations of a wholesale and stuff like that, this guy did not see any importance of ensuring that there's proper record keeping within his business. So what he was just comfortable because the transaction were going well, suppliers were supplying, checks were being approved and all that. So he took it normally that everything is okay, but at the long run he was losing a lot of money due to lack of proper maintenance of the records. Then we have irregular transactions. In some sole proprietorship, income and expenses may be irregular or seasonal. This means that this inconsistency can cause owners to delay or even skip record keeping, thinking it is unnecessary during slow periods. So when you talk about irregular transactions, we say that in some sole proprietorship, income and expenses may be regular or seasonal. So these inconsistencies can cause owners to delay or skip record keeping, whereby you don't have a continuous flow of income or a continuous expenses. So there will be, you might not see the proper importance of record keeping. Also, limited use of technology. Some businesses or small business owners may rely on manual record keeping. Like if they are doing bookkeeping, they want to do it handwritten and stuff like that, like notebooks or spreadsheets, rather than using accounting softwares, which can increase, the softwares can be able to reduce errors and the omissions. But with the manual is likely to increase the errors and omissions. And lastly, we have an organized record keeping system. So without a proper system or controls, receipts, invoices, and any other financial documents may be lost. So this leads to misplaced or even not collected, leading to incomplete records in that manner. So that is how you answer that question. Now questions. The third question, part C. Summarize 4 objectives of preparing financial statements of an organization. Summarize 4 objectives of preparing financial statements of an organization. Now, definitely when we talk about financial statements, we are talking about the formal records that summarizes the financial activities and positions the business or organization or even individuals over a specific period. So these formal records, they provide essential information to stakeholders such as investors. The investors use the records to decide where to invest, whether to invest or not. The creditors will use the formal records to determine the financial stability for them to know when whether you have the ability to repay their debts or not. The management, they use these records in making decisions, and even regulators, helping them to make informed decision, all those stakeholders. When you talk about, before I talk about the objectives of preparing these financial statements, when you talk about the main financial statements that we have, probably we can talk about, like, for example, the income statements. So the income statement with components such as revenues, like how much sales you're making, then you make, you calculate the cost of sales for you to determine the gross profit, then you less the expenses for you to be able to get, from the expenses for you to be able to get the net income, to be able to determine whether you are going to get the net profit or net loss. So income statements are very crucial kind of documents. Then we have the balance sheet, which is the purpose is to show the financial position for the organization. So in the financial position or in the balance sheet, we are dealing with the key components, like, for example, assets, liabilities, and of course the owner's equity, to determine the financial position of the assets. We have the cash flow statements. When you talk about the cash flow statements, this shows the movement of cash between the cash that is coming in as cash inflows and the cash that is going out as cash outflows. So when you talk about cash financial statements, we are going to have a question on that later. We look at 3 things. We are looking at the cash flow from operating activities. We are looking at the cash flow from investment activities, and we are looking the cash flow from the financing activities. Then, of course, we have the statement of the owner's equity, that is the capital statement for sole proprietorship, which shows the changes of the owner's capital over a period of time. So these financial statements are very crucial because they help evaluate performance. They help monitor the financial health of the business. They help support decision making. At the same time, they help in terms of legal and tax compliance, and also they help to attract basically investors. So when we talk about the objectives of preparing this statement, which are some of the things that I've spoken about, firstly is that they're likely to provide financial information. So financial statements, including the balance sheet, for example, income statement, cash flow statements, they present a clear picture of an organization's financial position. Like, for example, you can talk about the assets, the liabilities, the equity, and all that. Also, they talk about the performance, like the revenues that we are getting, the expenses we are incurring, and how much profits are we making. And also the cash flows over a specific period. So this information helps users to understand how the organization is doing financially and how resources are being managed. Also, secondly, they assist in decision making. Financial statements provide essential data that stakeholders rely on when making informed decisions. Now, especially talk about the management. Management uses them to plan operations, to control costs, and even to set budgets. Investors assess the viability and the profitability of organizations using these statements before making or before committing capital to them. If you talk about creditors and lenders evaluate the organization's ability to repay the debts and decide whether to extend the credit or to hold until they clear the debts that are already been incurred. Employees and customers, they also use these statements in making informed decision. They may also use the information to understand the company's stability. For example, the employees, for them to continue working in the organization, they will want to know the stability of the organization. That can only be understood from checking on the financial statements. The customers will want to know if they will continue working with these customers, if they will continue consuming goods from these businesses when they are convinced that the businesses are financially stable within that industry. Thirdly, they help to ensure accountability. Financial statements serve as a reporting tool for management to show how well they have managed the organization's resources. So this accountability helps to build trust with stakeholders, governance agencies, and even public, and demonstrate that funds have been used properly and accordance with the policies and objectives. So you will find that most of the organization, when it comes to the end of the financial year, they do report or they do produce the financial statements. These financial statements determines whether the organizations are being properly led, whether the money is being properly used and all that. Look at, for example, the public sectors. Public sectors are audited after every financial year, and the auditor submits the report of the auditing. Now, when the auditors go to the ground, they're going to look at how the resources that were allocated to these public procuring entities or public organization, how those resources were used. So the organizations are going to be accountable by producing proper financial statements that accounts for all the resources that were available. That is why if you are able to prove that yes, the resources were 100% accounted for, then you can be given a clean bill of health. But if you are unable, then of course you will find that the auditor will raise issues in relation to the accountability of such kind of organization. Fourthly, we have compliance with regulation. Organizations are legally required to prepare and submit financial statements that comply with accounting standards, tax laws, and regulatory frameworks, e.g. like IFRS and GAAP. This ensures that there is transparency and protects the interests of all stakeholders, preventing fraud and financial mismanagement. So in fact, even for you to determine how much tax that you are going to pay even to the government, it means that you have to prepare the financial statement for the determination in terms of how much profit you're making, so that we can be able to determine how much tax that you're going to pay. Fifth is about assessing profitability and financial health. Financial statements will enable analysis of, like, for example, profitability. So for us or for organizations to determine how much profits they've made or whether they're making profits or losses, it means that they have to prepare these financial statements. So profitability, it means that how well the organization generates profits from its operations, and the metrics like net profit margin help in understanding efficiency. Liquidity, the ability to meet short-term obligations measured by current and quick ratios is also helps to determine the financial health, and the solvency in terms of long-term financial stability, and the ability to meet long-term debts assessed by debt to equity ratio and interest coverage. So this analysis helps stakeholders to understand the sustainability and the operational success of an organization for them to make the right decisions. Sixth is in terms of facilitate comparison. It helps to facilitate comparison. Financial statements enable users to compare the organization's performance over different periods. That means that it does a trend analysis or against other companies in the same industry in reference to benchmarking. So this comparison helps identify the strengths, the weaknesses, the opportunities, and even the threats that are likely to overcome the organization. This helps the organization to prepare for improvement and to take advantage of the opportunities available. We have support taxation and legal requirements. We have said that. Financial statements provide the basis for calculating taxes owed by the organization and support compliance with tax laws. At the same time, accurate financial records reduce the risk of legal penalties and audits. Also, it assists in raising capital. Clear and reliable statements improve an organization's ability to attract investors or even secure loans, as they provide the evidence of the company's financial viability and at the same time the credit network. Also, it aids in resource allocation. They can help manage decide how best to allocate resources with an organization. For example, whether to invest in new projects, whether to cut costs, whether to expand operation and such like decisions. And lastly, it helps to promote transparency and trust. So regular, accurate financial reporting promotes transparency, enhancing the organization's reputation and building trust with stakeholders such as employees, customers, suppliers, and the wider community. So those are the objectives of preparing financial statements in that perspective. So we come to the fourth question. Now the fourth question in this part asks, explain two categories of financial ratios. Explain two categories of financial ratios. Now when you talk about financial ratios are are quantitative tools derived from the company's financial statements. So which means that financial ratios are made or they're derived from the company's financial statements that expresses the relationship between different financial figures. So financial ratios help to simplify complex financial data into understandable measures by comparing key numbers such as profits, assets, liabilities, and even equity. So like for example, a financial ratio might compare the company's current assets to its current liabilities to assess the liability, or its income to shareholders' equity to assess profitability. So when you talk about different, before you talk about the importance of this financial, before you talk about the categories of financial records, no, the question is asking about two categories. Before we talk about those categories, what are the importance of financial ratios? When you talk about the importance of financial ratios, first, they help simplify financial analysis. When you talk about simplification of financial analysis, it means that ratios condense large volumes of data into simple, comparable numbers, making it easier to analyze and interpret financial performance. So in other words, sometimes you can get financial reports without proper knowledge of interpretation of these financial reports. It may become difficult for you to understand them. But when we are using financial ratios, they do what you call, they help to simplify the financial analysis, which makes it easier to interpret. Secondly, they assist in decision making. Managers, investors, creditors, and other stakeholders all use ratios to make informed decision about investing, lending, or even managing the business. They help evaluate performance. Ratios allow companies to assess their probability to assess their profitability, efficiency, their liquidity, and even their solvency. So this helps highlight areas of strength and weaknesses within the organization. Also, they can be used for benchmarking. Ratios can help compare the company's performance over time. That is the trend analysis for the last 5 years and stuff like that, and against competitors or the industry standards. So this is by doing peer comparison between how you are performing against how your competitors are performing and stuff like that, so you can be able to determine what factors are leading to the performance and stuff like that. Also, they help do or carry out risk assessment. So creditors, investors use ratios to evaluate the financial risk of a company, including its ability to repay the debts and even sustain the operations. Also, they help monitor the financial health. The ongoing ratios helps monitor the company's financial condition and detect earlier warning signs of trouble in case they are in the company. And lastly, they help facilitate communication. So ratios can provide a standardized way to communicate financial information to shareholders, or maybe to analysts, to regulators, or and maybe many other stakeholders that will be interested with the information. Now, when you talk about the different categories of financial ratios, the first category is liquidity ratios. Now, when you talk about liquidity ratios, these ratios measure a company's ability to meet its short-term financial obligations. That is, debts and payables due within 1 year. So under the liquidity ratios, first we have what we call the current ratio. Current ratios equals to current assets divided by current liabilities. This helps to indicate whether the company has enough assets to cover short-term liabilities. The second type of ratios within the liquidation or the liquidity ratios, we have what we call the quick ratio, and also known as the acidity test ratio. The quick ratio equals to, first you put into brackets the current assets minus inventory. Once you get the total, then you divide it by current liabilities. This is used to it's more strong than the current ratio, because it excludes inventories, since it may not be easily converted to cash in this particular ratio. So a high liquidity ratio suggests that there's a good short-term financial health, while a low ratio could indicate the potential liquidity problems within that organization. Second category, we have the profitability ratios. When you talk about the profitability ratios, these ratios assess the company's ability to generate profits relatively to sales, assets, and equity. They help evaluate the operational efficiency and the profitability. Like, for example, we have the gross margin, or what you call the gross profit margin. The gross profit margin is equals to gross profit divided by sales times 100. You're going to get this ratio in terms of percentage. So this is going to show the percentage of revenue left after subtracting the cost of goods. So the higher revenue left, or the higher the gross profit margin, it's better because it will help you pay your expenses. It shows that you are going to have enough remaining revenue to cater for your expenses. Then we have the return on equity. Return on equity equals to net income divided by shareholders' equity. This measures how effectively equity capital is being used to generate profits. And thirdly, we have the net profit margin. The net profit margin equals to net profit divided by sales times 100. This indicates how much net income you have earned per unit of sales in that. So higher profitability ratios indicate better performance and value creation on that. Thirdly, we have the third category, we have solvency ratios. When you talk about solvency ratios, Solvency ratios measure the company's long-term financial stability and its ability to meet long-term debts. They reflect on the financial leverage and the risks. They include, for example, number one, we have the debt to equity ratio. Debt to equity ratio equals to total debt divided by total equity. This shows the proportion of debt financing relative to shareholders' equity. Then secondly, we have the interest coverage ratio, which equals to earning before interest and tax divided by interest expense. This indicates how easily the company can pay interest on outstanding debt. So low debt to equity ratios generally imply low financial risk, while higher ratios suggest that reliance on debt financing is high. Then fourth, we have the efficiency ratios, or what you call activity ratios. Efficiency ratios evaluate how well the company utilizes its assets and manages its operations. These ratios reflect operational effectiveness. Like number one, we have the inventory turnover. Inventory turnover equals to cost of goods sold divided by the average inventory. This helps to measure how many times inventory is sold and replaced during the period. Then we have the asset turnover, which equals to sales divided by average total assets. It helps to show how efficiently assets are used to generate sales. Then we have receivable turnover, which equals to net credit sales divided by average accounts receivable, which indicates how quickly the company collects cash from customers. So higher turnover ratios generally suggest efficient management of resources. Then fifth, we have the market ratios. Market ratios assess the company's market value and the investor perception. They are important for shareholders and potential investors. Like firstly, we have the earning per share. Earning per share equals to net income divided by number of outstanding shares. This indicates how much profit is earned per share. Secondly, we have the price to earning ratio. Price to earning ratio equals to market price per share divided by earnings per share, which shows how much investors are willing to pay for each dollar or shillings for earnings. Then we have dividend yield. When you talk about the dividend yield, this equals to dividend per share divided by market price per share. So this measures the return on investment from the dividends. Then the sixth category, we have the cash flow ratios. These ratios focus on the company's ability to generate cash and manage cash flows. Like for example, number one, we have the operating cash flow ratio, which equals to operating cash flow divided by current liabilities. This indicates the ability to cover short-term liabilities with cash generated from the operations. Then we have the cash conventional cycle, which equals to days inventory outstanding plus days sales outstanding minus days payable outstanding. This measures how quickly a company converts its investment into cash. Then we have leverage ratios. While related to solvent ratios, leverage ratios specifically focus on the extent of debt in the company's capital structure. For example, you have the debt ratio, which equals to the total debt divided by total assets. This indicates the proportion of assets financed by debt. Then we have the equity ratio, which equals to total equity divided by total assets. This helps to show the proportion of assets financed by shareholders. And then lastly, we have the growth ratios. These ratios measures the company's growth over time in sales, earnings, or even dividends. So the sales growth rate equals to current year sales minus previous year sales into brackets divided by previous year sales, which shows the percentage increase in sales over the years. And then lastly, we have the earnings growth rate, which equals to current year earning minus previous year earning divided by previous year earning. So those are the different categories we have when it comes to financial ratios, which helps stakeholders in making the right decisions. Now, part 5 of this first question. Distinguish between historical cost convention and the going concern convention. Now, when you talk about historical cost convention, the historical cost convention states that assets should be recorded at their original purchase cost, which means that this is the amount that actually they were paid for when they were acquired, and not the adjusted for changes in market value. What that means, for example, is that if a company buys a machine for 10,000 shillings, it will continue to report the machine at 10,000 shillings on its balance sheet, even if its market value increases to 15,000 or even decreases to 6,000. So unless accounting standards require revaluation, then that asset will be accounted or will be recorded using its original purchase cost. Well, when you talk about the ongoing concern convention, the going concern, not ongoing, the going concern convention, the going concern convention assumes that a business will continue operating in the foreseeable future and not liquidate or even significantly downsize, which means that the going concern means that the company will be there for the many years to come. So when preparing the financial statements, a business doesn't report its assets at liquidation value because it's expected to keep using those assets to generate income. So the distinction between the historical cost and the going concern conventions, the first distinction in terms of point form, there is the basis of assets and liabilities valuation. We have said that in the historical cost convention records, it records assets and liabilities at their original purchase price. This means that the value shown in the books is based on the actual amount paid at the time of acquisition. In contrast to that, the going concern convention assumes that the business will continue to operate indefinitely, so assets are valued based on their going use rather than the immediate sale price. Second distinction, consideration of market value changes. In relation to historical cost does not account for changes in the market value or inflation after purchase. The asset remains recorded at the cost originally paid, which might not reflect its current worth. The going concern concept, however, justifies valuing assets in the way that reflects their utility to the business over time, not their liquidation value, thus, in direct consideration, their long-term value. Then thirdly, we have reliability versus relevance. Historical cost provides highly reliable and verifiable data since it's based on the actual transaction. However, it may lack relevance over time as the value of the money and asset prices changes. Whereas, when you talk about the going concern, it enhances relevance by preparing financial statements on the assumption that the business will continue, making it reasonable to defer costs and allocate expenses over multiple periods. Then we have the impact on expense recognition. Because the historical cost focuses on the purchase price, it leads to recognizing expenses like depreciation gradually over the asset's useful life, aligning with the going concern assumption. The going concern concept supports the deferral of expense or expenses, underlining that the business will not liquidate soon and should spread cost appropriately. And lastly, it's about assumptions about business continuity. Historical cost alone does not address whether the business will continue operating. The going concern convention explicitly assumes that the business will continue indefinitely, which affects how assets and liabilities are measured and how financial statements are prepared. So this assumption is fundamental for accrual accounting and for valuing assets at their operational rather than liquidation values. And my good candidate, that is how you answer those questions in question 1. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions. And also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.